How can you make better stock trades and better ETF trades, regardless of whether you're a long-term investor or a short-term trader? Good order execution is an absolute must. And here to talk with us about that is Andy McCorman. He's a managing director at Wallach Beth, which is based in New York City. They do institutional trading and execution. Andy, welcome to the Index Investing Show. Great to have you with us.
Thank you so much. Great to be on.
When it comes to buying or selling an ETF or a stock, people always have the question, what's the best way to execute that buy or sell order? Is it with a market order at current prices, or is it with a limit order at a predetermined price? What's your philosophy on market orders versus limit orders?
That's a great way to start this off. And I'll say that the first distinction that I would like everyone to make, and this goes for a retail level or an institutional level, is understanding that although an ETF is listed just like a stock, and it's going to clear just like a stock, whether you're trading it on E-Trade or Schwab or whatever your venue is for trading it, it operationally is also a stock. However, it trades far different. Now, the smaller orders, some of the same rules apply, but what we're going to discuss today is just a way to understand that the real value of the ETF is its underlying asset class, and we'll go over that in the interview. But for the purpose of this question, just like a stock, you want to be careful with a market order. So, and especially in an ETF, because ETF tends to be thinner, and they tend to trade around the asset value of the product underneath the ETF versus the actual ticket itself. So a limit order will protect you. Now, we understand that in a retail side, you want to get in this trade and get out and get the order done. So I'm going to introduce a term, if you're not already familiar with, called a marketable limit order. And what that means is look at the prices on your screen. If you're comfortable with that, then just put a buy order in, let's say 2 to 3 cents above your limit, if you're above the limit on the screen if you're buying, and a sell order 2 to 3 cents below the bid. You are protected by Reg NMS, so you won't trade at a worse price, but what you will prevent is the chance that a market order goes to a thin product, or at the time you send your order, another larger order clears out the market, and therefore you have a trade that could be down, 1, 2, 3% just on a mini odd lot. We've seen it often. So the advice for the question, again, is marketable limit order or a limit order, but certainly not a market order.
Andy McCorman of Wallach Beth joining us. Now, some ETFs, as you alluded to there, have very thin trading volume. So is there a minimum in terms of trading volume that investors should keep as a benchmark?
I don't usually stay with one because what happens is you can have an ETF around an index benchmark that is liquid, but it's just a new idea. For example, we all know the S&P 500 is ranked market cap weighted. Well, now there's ETFs that are dividend weighted. There's ETFs that are fundamentally weighted. So you as an investor may say, hey, I like that. I think that this idea is going to return some alpha or a little bit better than the standard market cap. However, the ETF is not as popular, so the average daily volume is lower. So the two things to look at are, is the underlying asset class liquid, and what does the spread look like? If the spread is not that wide, meaning the difference between the bid and the offer, then the ETF should be fine to trade for the size that a retail person is doing. And just keep in mind, if the underlying asset class is liquid, then you should be fine in the product. The average daily volume or the daily trading volume does not mean, if it's thin, that an ETF is going to close down. It just means that there's not as many pros and individual investors trading the product.
If you're just joining us, you're listening to the Index Investing Show. Pleased to be talking with Andy McCorman. He's with Wallach Beth, based in New York City. They do institutional trading and execution. Now, I've heard the argument, Andy, that stop-loss orders are a bad idea for an ETF investor because they can get kicked out of a position if the fund suddenly hits that price and then suddenly bounces back and they lose that upside opportunity. So what's your take about stop-loss orders? Do they do more harm than help?
Well, here's the thing I would say about stop-loss orders. It really is up to the individual investor and what his goals of the investment are. It's hard to make a blanket statement that you should use them or not. I would start out by saying, not to have a cliche, but it's always seemed like kind of a Murphy's Law thing. You put, like you mentioned, you put your stop loss order out there. There's a bad day. It hits the stop at your level, which happens to be the low for the year, and then all of a sudden the stock rallies. I mean, we have seen that, but I do think, like I said, that's kind of a Murphy's Law thing. You got to look at it from the other side of the coin. A lot of listeners, I'm sure, to this program are not full-time traders, so they have their levels, right? They might set them for the day. Maybe they set them for the week, or maybe they put a GTC order in for a month. Well, you don't want to be on vacation when an index or a market collapse, or let's say the market goes the other way and you're short, and you miss your move because you weren't prepared. So it's hard to tell somebody that when the market takes an 8% correction, and you would have been out at 1% if you had a stop loss order, that you shouldn't have a stop loss order, right? You just need to know what they are. And I would also add that you can use a stop limit order. So therefore, you don't have that kind of order where it triggers it and then goes to the next exchange and maybe trades down another 10, 15 cents. But if your goal is, I do not want to lose more than 2% on this investment, and you can't be in front of your trading screen every day, then there is a place for stop loss orders in your investment, ETF or equity, that is.
Now, all securities that trade on an exchange, including stocks, will have a bid-ask spread, and the larger that spread, the larger the trading cost is to the investor. Now, for ETF investors, how can they limit the financial impact or cost of bid-ask spreads?
Well, this is where you have a little difference, and I always like to tell the truth, and I don't pull any punches when it comes to ETF investing and trading. So I will say that institutional investors have a slight advantage when dealing with a wider spread ETF. And that involves the creation redemption mechanism behind an ETF, and that larger blocks of ETFs can be hedged easier by the market makers that make the markets and the products. So, but for this call and for this, conversation, for a retail investor worried about spreads, they are relevant. And you're absolutely right, and it's a great point to point out that a large bid-ask spread does affect your trading cost. If you're trading an ETF that's 20 cents wide and there's a similar ETF that is a penny wide, well, then it's important that if the product is correlated enough and doesn't differ from your strategy, then as a retail investor, you will have lower trading costs by trading the ETF with the tighter spread, and it will limit the financial impact. ETFs do mature every day, though, and what I mean by that is an ETF idea garners popularity as the begins to get more volume. The spreads tighten quicker simply for the competition aspect that's going on in trading. So an ETF that you like and might be too wide for you to trade today as a retail investor, make sure you get in a correlated investment so you have your exposure to the asset class or the index. And just keep checking back, because you might be surprised that the spreads tighten on that ETF as time goes on.
That's a great point. And also, it depends, too, how long you plan on holding that ETF. I mean, that could be a factor also.
Absolutely true. I'm glad you pointed that out. If you're going to hold an ETF, for a year or 2 years, and especially since the show, is about indexing, and most indexing investors tend to be more long-term and less tactical, right? So if you're tactical and you're crossing that 10-cent wide spread, even if you're trading I would say once a month, that's going to affect you. But if you are a long-term holder, I would say get your marketable limit order in there. A spread that's 10, 20 cents wide over the long term is not really going to hurt you. Of course, always be wary, though, because there is ETFs out there with dollar spreads. So always make sure you check the first two digits when you're putting that trade in.
Market liquidity, an often misunderstood term. Explain quickly what it means and how it applies to the ETF investor.
Absolutely. We kind of went over it real quick on those other points, and I'll just point it out real quick with a real simple example. Market liquidity in an ETF term is how liquid are the assets that make up the ETF trading. And to put it real simple, we all know how liquid the S&P 500 are. The 500 stocks that make up that index trade extremely liquid. The ETF, S&P, SPY, also trades extremely liquid. If I came out with an ETF that ranked the S&P 500 in alphabetical order, that wouldn't be a great investment idea, correct? But the underlying asset class would be the S&P 500. So technically, the ETF could be very liquid if it needed to be.
Great explanation and great ideas. Thank you so much for sharing your knowledge with us. You just heard from Andy McCormick of Wallach Beth. This is the Index Investing Show. I'm Ron DeLegge, and I'll be right back after this short break.
The Investing Show with Lon DeLegio.